So we've talked about the reputable exchanges. We talked about the excitement of an IPO. Let's get to the fun stuff. What are the stock exchanges to avoid? OTC, over the counter. If you see a stock listed over the counter, you want to stay away. Whether you see a stock listed on pink sheets, PINK, you want to stay away. Or if you see a variation, OTC-BB, it stands for over-the-counter bulletin board. Again, you want to stay away. It all means the same thing, all these three different exchanges. The stock does not qualify, or the company cannot afford the very expensive listing fee for these companies to be listed on a major stock exchange, such as the New York Stock Exchange or the NASDAQ exchange. You want to stay away from companies that trade over the counter or on pink sheets because they're unregulated. There's no listing criteria. There's no standards the company has to reach, really. It's a bit of a free-for-all. But unfortunately, a common misconception is that stocks that trade over the counter could someday trade on a major exchange again. But this is extremely rare. And the only case I'm familiar with is American Airlines, which there's a story to it. The story of American Airlines trading over the counter, it occurred when the company actually went bankrupt. And only after some capital infusion and a major corporate restructure was American Airlines able to return to a major stock exchange. But for a minute there, a couple months, American Airlines was over the counter. The problem with over-the-counter stocks is stock promoters and scam artists. They love to tell magical stories about stocks that trade over the counter and how they're soon to be the next Microsoft. They're soon to be the next this. They're soon to be this up-and-coming company. The reality is that it's not true. All these stories are fabricated, and it's something you want to stay away from. You want to stay away from the promoters. You want to stay away from the over-the-counter exchanges because the two go hand in hand. The challenge is there's a hidden danger. The hidden danger is liquidity, or in the case of over-the-counter, lack of liquidity. So when I'm talking about liquidity, I'm talking about volume. Volume is the number of shares that traded hands in a given day. With no volume, there's no buyers and no sellers. There's really no market. To just give you some perspective, shares of Apple are traded millions of times every day. Shares of over-the-counter stocks, they might trade 100 times, they might trade 500 times, 1,000 times if it's a good day. There's not nearly enough volume, and the volume is liquidity. What I mean by liquidity is how easy it is to get in an investment and out of an investment. And we talked a lot about in the previous module about bids and asks and spreads, and how that plays in is these low volume stocks. They don't get enough volume, so the bid and the ask spread is massive. And so what happens is you go to sell your shares and you end up not getting the price you think you would get for the shares. You go to sell them at 10 cents, you're only getting 7 cents kind of thing. You're really getting ripped off when you sell it. And the reason for that is there's not enough liquidity. There's not enough volume. And where things get dangerous is with these stock promotions, because the promotion provides temporarily liquidity. And we talked about the bid-ask spread. There's not enough average volume, but in a promotion, there's a lot of people buying in and it provides liquidity. Unfortunately, what new investors don't realize is this newfound liquidity is the insiders running the promotion is buying and selling, and at the end of the day, all these stocks crash. They go to zero, and what can happen is you're left what's known as holding the bag, meaning you're holding a bunch of worthless stock. Now, if you haven't seen the movie The Wolf of Wall Street, definitely take a look at it. Not only is it entertaining, it's very educational, and I'll say it 100 times, stay away from over-the-counter pink sheets, over-the-counter blackboard stocks, stay away from penny stocks. Again, we'll talk about the difference between penny stocks and small cap stocks. Maybe you've heard that expression. Well, we'll definitely discuss the difference, but you definitely want something that trades on the NASDAQ or the New York Stock Exchange, because those exchanges provide lots of volume for the stocks, lots of liquidity. So you may have heard the term average volume. Now, average volume's the average number of times a stock trades hands in the day. So volume, the number of times a stock trades hands in a given day. So the average volume is the average daily volume taken over either a 30-day period or a 90-day period. So if a stock usually trades 1 million shares in a day, maybe on a low volume day it only trades 700,000. On a higher volume day, it trades 1.5 million. So the average is about 1 million. So average daily volume of 1 million, you're never going to have any problems with liquidity or anything like that. And maybe you've heard the term relative volume. Relative volume is, again, comparing the volume for that day, and it's comparing it to the average volume taken over a 30-day period or a 90-day period. Different companies calculate average volume differently. So if the relative volume's again, it's a ratio. So if the relative volume's 2 on a $1 million shares per day average volume, the relative volume is 2. So the higher the relative volume, basically the higher the volume is in relation to what it usually gets. And this is just a term that you may find helpful, because if you're searching for high relative volume, you could be finding a stock that's really gaining some momentum. So it's just more of an insider thing that can really help you find some breakout stocks, ones that are high relative volume. If a stock normally trades 100,000 shares a day and it receives 2 million shares in a given day, the relative volume is 20. And that's a big move, and maybe there's something going on with the company. So we're going to have a whole module dedicated to finding stocks, and relative volume is a little tool you should have in your toolbox to help find maybe breakout stocks. I know that's what everyone is looking to find, the next breakout stocks. Well, the relative volume can direct you towards some serious momentum.